Gold has just done the unthinkable. It's smashed through the $5,000 an ounce barrier, hitting a new all-time high. If you're wondering what on earth is going on and what this means for you, your savings, and the global economy, you've come to the right place. In the next few minutes, we're going to break down exactly why gold is skyrocketing, what the experts are watching for next, and how you can navigate this historic moment. Stick around, because this is information you need to hear. So, how did we get here? Why is gold suddenly worth more than ever before? It's not just one thing, it's a perfect storm of factors. First, let's talk about the big one: economic uncertainty. All around the world, there's a growing feeling of instability. Major economies are slowing down. Inflation is proving stubborn, and geopolitical tensions are on the rise. When people get nervous about the future of their currencies and the stock market, they flock to what they see as a safe haven. And for thousands of years, gold has been the ultimate safe haven asset. It's tangible, it has a limited supply, and it isn't controlled by any single government or central bank. Then there's the role of central banks themselves. You might be surprised to learn that central banks around the world, especially in emerging markets, have been buying gold at a record pace. They're trying to diversify their reserves away from the US dollar. This massive, sustained buying pressure from some of the biggest players in the financial world creates a huge demand for gold, pushing the price higher and higher. It's a major vote of confidence in gold's long-term value. Finally, we have the inflation factor. Even though some official numbers might suggest inflation is cooling, many people feel that the cost of living is still painfully high. When your money buys you less and less each year, holding cash is a losing game. Gold, on the other hand, has historically been a fantastic hedge against inflation. As the purchasing power of currencies like the dollar or the euro declines, the price of gold in those currencies tends to rise, protecting your wealth. The surge to $5,000 is a clear signal that investors are betting on inflation remaining a problem for the foreseeable future. Now for the million-dollar question, or should I say the $5,000 question, what happens next? With gold at these unprecedented levels, what should we be watching? The first thing is the reaction of the Federal Reserve and other major central banks. Will they continue with their current policies, or will this historic gold price force them to change course? Their statements and actions will be critical. If they signal a more aggressive stance to fight inflation, it could temporarily cool gold's rally. But if they seem unconcerned, it could add more fuel to the fire. Another key indicator to watch is the physical demand for gold. Are people still buying gold coins, bars, and jewelry at these high prices? Are industrial uses for gold, like in electronics, holding up? A slowdown in physical demand could be a sign that the price has gotten a bit ahead of itself. Conversely, if demand stays strong or even accelerates, it suggests the rally has strong legs and could continue. We'll also be closely monitoring the mining sector. Are gold mining companies increasing production to meet this demand? Their ability to bring more supply to the market will play a big role in where the price goes from here. So what does this all mean for you as an individual investor? It's crucial to remember that past performance is no guarantee of future results, and investing always carries risks. The key is to stay informed and think about your own financial goals. Many financial advisors suggest that having a small allocation to gold, maybe around 5 to 10% of your portfolio, can be a smart way to diversify and protect against uncertainty. It acts like insurance for your other investments. Whether you choose to invest through physical gold, gold ETFs, or mining stocks depends on your personal risk tolerance and objectives. The surge to $5,000 is more than just a number. It's a major event in financial history that reflects deep-seated concerns about the global economy. It's a wake-up call for all of us to pay attention to our financial health. By understanding the forces driving this rally and keeping an eye on the key indicators we've discussed, you can make more informed decisions to navigate these turbulent times. To understand why gold is being pulled higher with such persistence, it is necessary to look past headlines and into the internal mechanics of the global financial system. Markets do not move in isolation. They move because the structures that support them either strengthen or weaken. What is happening now is not a sudden change in sentiment. It is the visible consequence of stresses that have been building quietly for years. At the center of those stresses lies sovereign debt. For decades, the global economy has relied on a simple assumption: that governments can always borrow more, and that their bonds will always be treated as the safest assets in the system. This assumption is not merely theoretical. It is embedded into bank regulations, pension models, insurance frameworks, and the entire architecture of modern finance. Government bonds are not just investments. They are collateral. They are reserves. They are the foundation upon which leverage is constructed. The problem is not that debt is high. The problem is that it has reached levels where the system can no longer tolerate normal interest rates. When rates rise, debt servicing costs rise with them. For heavily indebted governments, this creates a political and fiscal trap. Either rates must be suppressed or budgets become mathematically unworkable. This is why bond markets today no longer function as truly free markets. They are increasingly managed, guided, and in some cases directly supported by central banks. Prices are not discovered purely by risk and return. They are shaped by necessity. This leads to a more subtle but far more dangerous development, the erosion of the risk-free asset. In theory, government bonds are supposed to represent the baseline of safety in the financial system. Everything else is priced relative to them. But when the safety of those bonds depends on constant intervention, their role changes. They may still be liquid. They may still be widely accepted. But they are no longer unquestioned. This has profound consequences. Banks hold sovereign bonds as core assets. Pension funds depend on them to meet long-term obligations. Derivatives markets use them as primary collateral. When confidence in their real value begins to weaken, the entire chain of financial trust becomes more fragile. At this point, it becomes important to distinguish between two concepts that are often confused: liquidity and solvency. Central banks are very good at providing liquidity. They can create money to stabilize markets, calm panics, and prevent sudden collapses. What they cannot create is solvency. Solvency is a balance sheet condition. It depends on whether assets are truly sufficient to cover liabilities over time. When debt burdens grow faster than productive capacity, no amount of short-term liquidity can fix the underlying imbalance. Gold does not respond to liquidity cycles, it responds to solvency risk. Another critical piece of the puzzle is collateral. Modern finance is built on chains of pledged assets. The same bond can be used multiple times in different transactions through a process known as rehypothecation. This system works efficiently when trust is high and asset quality is unquestioned. But it becomes dangerously brittle when doubts begin to emerge about the true value or stability of the underlying collateral. When that happens, participants demand more margin, higher quality assets, or shorter durations. This tightens financial conditions, even without any official policy change. It is a silent form of stress that rarely makes headlines, but it can freeze markets with remarkable speed. In such an environment, assets that do not depend on anyone else's promise become more attractive. Gold has no counterparty risk. It does not require a payment system to function. It does not depend on the solvency of a government or a bank. This is not an ideological argument. It is a balance sheet reality. When systems become more complex and more leveraged, simple assets gain strategic value. There's also a broader geopolitical dimension to this shift. The world is slowly moving away from a single, unified monetary order toward a more fragmented one. Trade is being reorganized. Payment systems are being duplicated. Reserve strategies are being diversified. This does not mean that any one currency is about to disappear. It means that the era of unquestioned monetary centrality is ending. In a fragmented world, every reserve asset carries political implications. Gold is the only major reserve asset that is not someone else's liability. This is why it continues to appear, quietly but persistently, on central bank balance sheets across a wide range of countries. It is not being accumulated for short-term profit. It is being accumulated because it functions in almost any political or financial environment. From this perspective, the rise in gold is not mysterious at all. It is the natural response of a system that is becoming more constrained, more leveraged, and more politically managed. The machinery of global finance is still running. Transactions are still clearing. Markets are still open. But the tolerance for shocks is lower than it appears, and the dependence on confidence. When financial systems begin to shift, the most important changes rarely appear in headlines. They appear in balance sheets, in reserve allocations, and in the quiet adjustments made by actors who are not seeking attention, but survival. The rise of gold to unprecedented levels is not being driven by a single group. It is the combined result of very different motivations across the global financial hierarchy. At the top of that hierarchy sit central banks and sovereign institutions. Over the past several years, they have been consistent buyers of gold, often during periods when the price was not making headlines. This behavior is not speculative. Central banks do not trade, they allocate, and their allocation decisions reveal how they perceive long-term risk. When these institutions increase their gold holdings, they are not expressing a view about next quarter's inflation data. They are expressing a view about the long-term reliability of the existing reserve system. For much of the post-Cold War period, reserve management was relatively simple. A large portion of reserves could be held in the bonds of a small number of highly trusted governments. That world is changing. Political risk, sanctions regimes, and the weaponization of financial infrastructure have forced many countries to reconsider what safe actually means. In that context, gold is not an alternative investment. It is a form of monetary insurance. Below the sovereign level, large institutions are making a different but related calculation. Pension funds, insurance companies, and endowments operate under long time horizons and strict liability structures. Their primary risk is not missing a rally. It is failing to meet obligations in a stressed environment. For years, these institutions were pushed into increasingly complex strategies in order to generate returns in a world of suppressed interest rates. That complexity worked as long as volatility remained contained and correlations behaved as expected. But complexity is a form of hidden leverage. As systems become more fragile, institutions begin to favor assets that simplify rather than optimize. This does not always mean large, visible shifts. Often it means small changes in allocation, new hedging policies, or a greater emphasis on assets that behave differently from the rest of the portfolio under stress. Gold fits this role not because it always rises, but because it tends to behave differently when confidence in paper assets is under pressure. The banking system occupies a more uncomfortable position. Banks are structurally dependent on confidence. Their business model assumes that assets can be valued, collateral can be trusted, and funding markets will remain open. They are also deeply intertwined with government debt markets, both as holders and as intermediaries. When sovereign bonds become more volatile or more politically managed, banks are exposed in ways that are not always visible in simple capital ratios. At the same time, banks are generally not free to make radical shifts in their balance sheets. Regulation, accounting rules, and business models constrain their flexibility. This means they are often forced to react to stress rather than prepare for it. In such an environment, a rising gold price is not a profit opportunity for banks. It is a reflection of a world in which their operating assumptions are becoming less stable. Commodity-producing countries and exporters face yet another set of incentives. For some, higher gold prices and higher commodity prices in general provide a buffer against currency weakness and external financing stress. For others, especially those dependent on imports or foreign currency funding, the same environment creates additional pressure. The divergence between these two groups is one of the reasons global economic conditions are becoming more uneven and more politically tense. Then there is the retail investor. Historically, the public tends to arrive late to structural shifts. This is not a matter of intelligence. It is a matter of incentives and information. Retail behavior is shaped by headlines, recent performance, and social proof. By the time a move is widely discussed, it is usually no longer about early positioning. It is about emotional response. This is why it is important to distinguish between two very different types of participation in the gold market. One is strategic and long-term, driven by balance sheet considerations and systemic risk. The other is reactive and short-term, driven by price action and fear of missing out. They may buy the same asset, but they are not playing the same game. There's also a political layer to all of this. Governments have little incentive to highlight what a rising gold price implies. Official narratives tend to emphasize resilience, growth, and successful management of the economy. Admitting that a neutral, non-yielding asset is being accumulated as a form of insurance against the system itself would undermine confidence in that system. As a result, policy responses to stress often focus on appearances rather than structure. This usually means more intervention, more guarantees, and more short-term stabilization measures. These can delay crises. They rarely eliminate the underlying causes. What is emerging, slowly but clearly, is a divided financial world. On one side are actors who are reducing their dependence on the smooth functioning of the existing system. On the other are those who remain fully exposed to it, either by necessity or by design. What if I told you that gold hitting $5,000 an ounce aren't the party you might think it is? It sounds like a fantastic milestone for investors, but peel back the shiny surface and you will find it's actually a massive warning sign flashing red for the entire global economy. Let's break down what a $5,000 gold price really means. First, understand this. Gold doesn't just shoot up for no reason. A price like that signals a catastrophic loss of confidence in the world's most important currencies, especially the US dollar. Think of it as people desperately swapping their paper money for something tangible, something real. This isn't just about inflation being a little high. It's about a fundamental breakdown of trust in the financial system. When that trust evaporates, the first victim is the bond market. For decades, US government bonds have been the safest place to park your money. But in a world where the dollar is rapidly losing value, who would want to hold a bond that pays back in those depreciating dollars? The answer is very few people. We'd see a massive sell-off. Interest rates would have to skyrocket to attract any buyers at all, making it incredibly expensive for governments and businesses to borrow money. Imagine mortgage rates at 15% or 20%. The entire credit system would freeze. This currency crisis wouldn't stay contained. It would spill over into every corner of our lives. International trade would become a nightmare. How do you price goods when the value of the dollar is swinging wildly day by day? Companies would have to retreat, supply chains would break, and the globalized economy we've known for half a century would start to unravel. The price of everything imported, from your phone to your coffee, would become unpredictable and likely unaffordable. Then there's the stock market. You might think, well, at least my stocks will be okay. Not so fast. While some companies, especially those dealing in hard assets, might see a temporary boost, the broader market would be in for a world of hurt. The soaring interest rates we talked about would crush corporate profits. Consumer spending would collapse as people's savings are wiped out by inflation. A stock market crash wouldn't just be a possibility, it would be an inevitability, leading to a deep and painful recession, or worse, a depression. Beyond the financial chaos, the social fabric would begin to tear. When people can no longer afford basic necessities and their life savings disappear overnight, desperation sets in. We would see social unrest on a scale most of us have never experienced. The gap between the rich, who were able to protect their wealth and assets like gold, and everyone else would become a chasm. This kind of economic stress fuels political extremism and can lead to dangerous instability, both at home and abroad. So when you see headlines cheering for gold to hit $5,000, remember what you're actually cheering for. It's not a sign of prosperity, it's a distress signal. It's a barometer telling us that the financial storm we've been warned about is no longer on the horizon. It's here. The surge in gold's price isn't the goal, it's the consequence of a system in crisis. It's a loud and clear warning that our current economic path is unsustainable, and a painful correction is coming. The real question isn't if it will happen, but what we can do to prepare for the fallout. Thanks for watching. If you found this perspective valuable, make sure to like, subscribe, and hit that notification bell for more insights into the world of finance. Stay informed and stay safe.